Welcome to Global Dispatches, a podcast for the foreign policy, international affairs, global development community, and world news aficionados of all stripes. I'm your host, Mark Leon Goldberg, editor of UN Dispatch, and now on with the show. When economies started tanking last year as COVID-19 spread rapidly around the globe, the World Bank and International Monetary Fund mounted their crisis response. Both institutions stepped up their lending to lower-income countries and emerging economies alike in an effort to mitigate the economic fallout from the pandemic. Now, 1 year later, we can assess some of the impact of the responses by these institutions and assess what comes next as countries continue to try to weather this economic storm. On the line with me to discuss how the World Bank and IMF have responded to COVID-19 is Scott Morris, Senior Fellow at the Center for Global Development. We spoke just before the annual spring meetings of the World Bank and International Monetary Fund, which I think provides a useful inflection point to discuss both the actions that these institutions have taken over the last year and what new initiatives might be on the horizon, particularly as the new Biden administration settles in. I think you'll find this conversation useful. It's not necessarily pegged to the annual spring meetings, and we do spend more time discussing the World Bank than we do the International Monetary Fund. But towards the end of the conversation, we do have what I think is a pretty interesting discussion about how and why key figures like Janet Yellen, the new U.S. Treasury Secretary, are seeking to reimagine the role of the IMF and World Bank to tackle future global challenges. And just one quick thing before we start. If you are a regular listener to the show, I would so appreciate it if you could leave a review of the podcast on Apple Podcasts, Spotify, or wherever it is that you listen to the show. Writing a review is actually a selfless act because it helps other people who are similarly interested find the podcast. So thank you in advance. I so appreciate it. Now here is my conversation with Scott Morris of the Center for Global Development.
You know, a year ago, we were facing tremendous uncertainty and frankly, a huge amount of fear. If we think about, looking out at the global landscape, the pandemic itself, but also the economic effects of the pandemic, particularly in developing countries, many of which, among the poorest countries, even coming into this crisis, were in a bit of trouble, whether, in terms of debt loads or overall economic performance. So, with this crisis hitting, in the very earliest days, there were just deep, deep fears about the impact this was going to have, particularly in the developing world, even as, those of us in wealthy countries, had fears about what we were facing at home. So there clearly was a mandate and a focus on the World Bank to step up and act. So what we saw was, I think, late February, March of last year, the bank announced its package of crisis commitments of on the order of about $160 billion. And that was a commitment on behalf of the entire institution, meaning, the lending that it does to governments in different kinds of developing countries, the poorest, and all the way up to emerging markets, but also through the IFC, the International Finance Corporation, which is its private sector investment arm. So that was the starting point for the bank's response to the crisis.
So there was this suite of $160 billion of investments that the World Bank said it was going to spend. Did it actually disperse that amount?
Well, you pointed to an important distinction when we use the word disperse versus commit. This, in fact, deserves some scrutiny. And in fact, with colleagues at the Center for Global Development, we took some time to look at this. So on the one hand, the bank clearly has moved forward in a way that it has been able to scale up its commitments to countries. And commitments are really the start of the process of the funding relationship. So whether it is a project commitment, a commitment to build a new road, to fund a health clinic, or a commitment simply to support the budget of the developing country, that's the starting point for the bank. Now, the question of disbursement, meaning actual money flowing from the bank to the developing country government, is different in the sense that, in normal times outside of a crisis, disbursements can vary a lot because projects vary a lot. It can take 5 years more to do a big infrastructure project. So, the bank might announce a commitment of $1 billion to a country, but the disbursements might take, frankly, years to proceed. Now, there's a crisis imperative in the context of the past year, which is why we wanted to look at this question that, there's that's all well and good for normal times, but if we are expecting to developing countries to scale up their fiscal response to this crisis, as we in the US certainly have done very aggressively and continue to do, they need actual money coming from, particularly from institutions like the World Bank, because many of them either don't have any market access. They can't simply go and issue bonds in external credit markets the way the U.S. can. So they really are particularly reliant on the World Bank. And again, it really matters, not just the commitment that the bank makes, but the money out the door. You can't spend a commitment. You can spend a disbursement. So, we were interested in looking closely at that, tracking both the commitments and the disbursements. And there's a third element to the equation when it comes to the World Bank's relationship with these countries is how much are the countries themselves paying back to the bank in real time? Because that's sort of the other side of the ledger. And again, in a crisis period, that represents a drag on their ability to mount a fiscal response in their own economy. And if we just take a snapshot at any point in time, it could be that a country is actually repaying more to the World Bank than they are receiving in new disbursements. So that's we would call it a net negative flow. And, again, outside of a crisis period, that's not necessarily something to be terribly worried about. It's just sort of a mismatch in the timing of projects. But again, there's just this overriding imperative about crisis response. So it would matter a lot if we're looking at countries and seeing that, over the course of 2020, perhaps on a net basis, they're paying back to the World Bank as much as they're receiving in new money. And that's a situation where, frankly, it's hard to see how the World Bank is doing them much good in fighting this crisis.
So I think that sets up your research nicely into what actually the World Bank has dispersed from this $160 billion commitment. Where has that money gone?
Yeah, so I think the bottom line is the picture is mixed, and it's certainly not wholly negative. Number one, when it comes to both commitments and disbursements, the bank has clearly mounted a crisis response. So it's not just business as usual. We do see an uptick in the numbers overall, but it does vary across countries and even regions and types of countries. So, number one, the disbursement rate has been most aggressive, most positive in Africa, which also includes some of the bank's poorest client countries. So that's clearly that's a positive, and those numbers actually can look really very significant, even as a share of these countries' economies. Like it's very clear that the World Bank's crisis financing is helping to mount a significant response in those countries. And as we look at our list, that includes Sierra Leone, Niger, Rwanda, among those who, on a net basis, are seeing very significant positive flows from the bank. But then what's striking is that there's actually quite a large list of countries, roughly a third, a bit more, where these net flows, frankly, just are not on, not, they're just barely in the positive. So, that you are seeing repayment streams that are significant, but more importantly, the new disbursements are not all that significant. So while there really aren't, there are virtually no countries that are, on a net negative basis that they're having to pay back more than they're receiving. But there are a troubling number of countries where there just isn't a large and significant uptick in what they're receiving from the bank relative to their repayments. Then the other, I think, lens we can look at this through. I mentioned the poorest countries, but the bank as a whole serves a wide range of developing countries, and as I mentioned earlier, that includes emerging market countries. And what's very clear is that when we look at the arm of the World Bank that is lending to these countries, we call it the IBRD, it clearly has not mounted anything like the crisis response that the other arm of the bank serving the poorest countries, called IDA, has mounted. So that seems to reflect some kind of decision making and prioritization within the institution. Yeah.
But basically, at some point, the institution decided that it would target most of its support to lower income countries, not necessarily emerging markets.
I think that's the simple version of it. There's, I think there is more complexity to it. Number one, these are two distinct arms of the institution. Even legally speaking, they have their own balance sheets. So it's not really that there's a direct financial trade-off between the two arms. But there are other ways that we can see prioritization. And in fact, the IDA that does support for the poorest countries is currently in the midst of some very aggressive fundraising from donors in order to support continued scaled up efforts. Whereas, on the IBRD side, it was striking. I was, listening to some comments from David Malpass this week.
And he's the head of the World Bank.
President of the World Bank. And, he basically said, well, for the IBRD, people talk about the need for more capital, but I don't see it right now. I think we're doing just fine. And, I think one reason they're doing just fine in terms of the health of their finances is, frankly, they didn't do any, huge scale up in lending. And, importantly, compared to what, and we can compare it to a decade ago in the midst of the global financial crisis, where you did see a very rapid and large scale up in IBRD lending to the middle income countries.
So you sketched out this kind of scenario in which the World Bank is doing a lot of lending right now. And in some cases, the amount that it's lending is not much greater than the amount it's owed by certain countries, which I think raises this kind of long-term question of what about the debt that a lot of these countries are incurring right now in order to fund their COVID responses? And is there a concern, particularly among the global development community, that this indebtedness might hamper a country's economic development going forward?
Yeah, that's right. It's important. I think all of the discussions around debt sustainability for these countries are directly linked to what we've been talking about, namely new lending from the World Bank, repayment of old World Bank loans. And interestingly, one element of this, of the debt relief discussions, is the fact that the World Bank and the other multilateral development banks are not participating in the G20's debt service suspension program. And
what is that program? Frankly, I am not aware.
This was agreed also last spring as a measure that the G20 governments would take to help support the poorest countries, and namely what they agreed to do was to suspend any repayments on loans these countries were making back to the G20 governments.
Okay, so like bilateral loans.
Bilateral loans is how it's shaped up. Now, that said, part of the announcement at the time was also that there should be efforts to include all classes of creditors, namely commercial creditors.
Mm.
That never materialized. But again, with our focus on the World Bank here, it's interesting to note, it was very clear early on that the multilateral institutions, were drawing a hard line and saying, we will not participate in this. And it's worth taking a minute to understand why they would take that position, which, at best feels a bit awkward.
Yeah.
Their argument basically is, we are not commercial creditors. We're not in this business to reap profits, to the degree that, we lend, and we do for the most part lend. We're not giving away money, and we charge some amount of interest. All of those earnings are going back into new support for developing countries. So if you ask us to stop the repayment flow, that is only going to have a negative effect on our ability to do new financing, even in this crisis period. And they worried a lot about what the credit rating agencies would have to say about, basically their ratings as a result of participating in this. So I think the G20 governments more or less accepted this, although, strikingly, the Chinese government in particular has been consistently critical and has called on all the MDBs to participate. But the outcome is that they do not. So while if you're the Chinese government, for the most part, if you're the U.S. government, the Europeans, you have suspended those payments. The World Bank has not. So that is, that's one important element of this of the debt relief conversation. But then, the other, and I think, in favor of the World Bank's position, like I said, they are very worried about anything that would disrupt their ability to offer new financing. And what's important about that is not just the volume of money that's flowing, which we are measuring in our research. It's also the terms. As I said, the World Bank is not a commercial lender, and one way that's meaningful is that for virtually all of its client countries, it represents a really good deal. So certainly for the poorest countries, many of them actually aren't receiving loans from the bank; they receive pure grants. But most of those low-income countries are receiving loans, but on very generous terms. Zero interest rate financing, very long grace periods. Even for those emerging market countries, the terms that they're getting from the IBRD are have a significant degree of what we would call concessionality. Basically, the interest rates are significantly lower than market interest rates. There are grace periods. So,
the idea is the World Bank is not trying to make money off of its lending to a certain degree.
And from the developing countries' perspective, that kind of money is exactly what they need, even from a debt sustainability standpoint, because one of the features of the debt risk that these countries are facing today is it's not so much, this big stock of debt, although that clearly is there. It's actually the repayment terms that are driving debt stresses today, because a lot of these countries, including some of the poorest, are borrowing much more from commercial sources today, which carry higher interest rates. So they're having trouble meeting those payment terms.
So have you been able to put a approximate number on actual disbursements from that $160 billion commitment?
So if we eyeball it as of the beginning of this year, and let me set aside what we did not do in our work was look at the IFC. So if you subtract the IFC's commitments, the goal was actually more along the lines of about $104 billion is what the World Bank was committing. And
just to remind listeners, the IFC is the International Finance Corporation. It's the private sector lending arm of the World Bank.
That's right. So lending into private activities in developing countries. So setting that aside, the goal from last year was about $104 billion. as of the beginning of this year, they had $72 billion in commitments and $42 billion dispersed. Now, the other important question is what was the intended timeline for all of this? And so they were setting out a program of lending that would take them through July of this year. So actually, by our projections, when it comes to the commitments, they're well on track, easily on track to meet their goal. But disbursements, again, by our projections, we would expect they're only going to make it to about $64 billion in disbursements by the summer. And I think our judgment is that frankly just falls short of what the countries have needed throughout this crisis period.
So there's been a lot of discussion about the need for a green recovery, that the funding that comes in for stimulus from multilateral banks ought to be directed towards climate sensitive investments. I mean, have we seen that actually happen over the last year?
Well, I should say it's not something that in our research we haven't looked at the sort of the sectoral distribution of the project. So I really can't say. My strong hunch would be that yes, I think we could see some greening of the response in the last year, simply because this clearly has been a priority for the institution overall in recent years. They in parallel with this crisis activity, the bank, as recently as 2018, had made some pretty aggressive commitments in the way of targets, overall financing targets for climate finance activities. So they've been under pressure to scale this stuff up. So I would fully expect that would be evident in the projects that we're seeing. And yes, I mean, there's definitely been this mantra of building back better, building back greener. I should say, I think there's some tensions here, and it does entail some real trade-offs that we should be, we should certainly be mindful of. And if you talk to folks in developing countries, I think they would be quick to point out that it's not the case that in every instance a climate project represents the best thing, the best way to spend World Bank money during this crisis period. And I think there is, I think we ought to have a little bit of, we ought to be a little cautious about fully embracing the idea that, crisis financing can exclusively be climate financing, and there's nothing lost in that.
Could you also briefly just explain the International Monetary Fund's role in COVID-19 response and recovery?
Well, I think one thing that's notable, and it actually it relates to the climate agenda, is that I think what we're seeing with the IMF in this crisis, which is sort of consistent with a trend of the last decade, is a more expansive notion of what the fund is supposed to do. So, in a strict and narrow sense, the IMF finances countries when they're having balance of payments problems. So, we would think of, again, if we look back a decade ago in the global financial crisis, countries were experiencing financial crises. So it could be, they lose access to hard currency, and the role of a big IMF loan is to support their reserves, to give them that kind of access. But I think we've seen sort of, again, more expansive ideas about the role that the IMF can play. So I think there are, very current discussions around the so-called special drawing rights of the IMF, the SDRs, which was, I think, the most obscure of instruments in international policymaking, and suddenly is on the lips of every CSO and NGO in Washington today. So it's really this striking phenomenon where suddenly the IMF is viewed yes, as a crisis lender, which it has always been, but more than that, sort of almost a development institution like the World Bank. So, for example, we're seeing with the SDRs proposals to channel those SDR resources toward climate projects, toward the pandemic itself, vaccine purchases. So I think that's all still very unsettled at the moment. It appears that they will go forward with a new distribution of SDRs, but so far, I think that will be for pretty traditional purposes and uses. And then, outside of that, in terms of the IMF's, the scale of their financing in this crisis, it's frankly been fairly modest. And I think that's, in that case, it's less clear that somehow the fund is being laggard or not responsive enough versus, we aren't seeing sort of this cascading set of financial crises in these countries and in the way that they would all be beating down the door of the fund asking for big bailout packages.
So lastly, we saw U.S. Treasury Secretary Janet Yellen sort of recently kind of call for a new Bretton Woods moment. The idea being that these multilateral institutions, the multinational banks, the IMF and the World Bank, that were created in the wake of World War II, now have to be refit for this new purpose. We have this great calamity, just as we did after World War II, and now we have this opportunity to reshape these institutions in ways to meet more current problems. I mean, does that strike you as a relevant comparison? And what would you expect from this kind of transitional? Do you expect this to be a transitional period for the IMF and the World Bank?
Yeah, so look, I think what we're seeing from Secretary Yellen is very exciting because it represents something big in my mind. As someone who's followed these institutions for many years, I think the biggest risk of failure for them in meeting the challenges, the global challenges that we have today is one of incrementalism. And that's, frankly, that's where we've been with these institutions, certainly over the last decade, is sort of modest steps, perhaps in the right direction, not always. And that reflects to a large degree the behavior of certainly the US government, other leading shareholders. So to have Secretary Yellen now just, demonstrating in a lot of different areas, certainly the financing areas, but even things like, her initiative on a global corporate minimum tax, that's just showing a degree of ambition that we haven't seen for these institutions in a while. And it suggests that, that there really is an appetite for much bolder action. And, we could, a year from now, be seeing just a much more ambitious agenda than, the alternative path, which would be, okay, the crisis is winding down. We can all settle down now and wind down the crisis stance of these institutions. When the reality is, there are just huge demands, preparing for the next pandemic and meeting the climate challenges. All of these things, point to, much more significant roles for these international institutions than really we've seen in terms of real commitments to date. So I think I think there's a lot to watch in terms of the behavior of the U.S. government as we see her early statements on this stuff.
Well, Scott, thank you so much for your time. This is fascinating.
My pleasure.
And I'll be interested to see if other countries kind of take up that corporate minimum tax proposal, which is very conveniently pegged to what would fund the Biden administration stimulus plan.
Yeah, that's right. I mean, there's a domestic side to it and the international, but they are linked. And I think what's interesting is the IMF, at least the chief economist of the IMF, has been out there saying we fully support this. David Malpass was asked about it, and he sort of hemmed and hawed and made it very clear he didn't want to talk about it. So,
oh, there you go. Well, thanks, Scott. I learned a lot.
Okay.
See ya. Bye. All right. Thank you all for listening. Thank you to Scott Morris, and I'll post a link to his analysis in the show notes of this episode. And a special thank you to my puppy Murray for his contributions at the tail end of this episode. We'll see you next time. Bye.